I'm your host, Dave Townsend. I'm joined today by RBC's Matt Swingle. Matt, welcome to the show.
Thanks so much, David. Great to be here today.
Hey, for those maybe a little bit new to you and RBC, you want to give us a little bit about yourself? Tell us a little bit about RBC.
Yeah, absolutely. So I joined RBC in 2022. Prior to that, I worked at a few large U.S. institutions, spending a lot of time within the derivative space and specifically with structured products. Here at RBC, we're really trying to lean into our growth within the U.S. We, of course, are one of the largest banks by market cap globally. We're a top 10, and we have a rapidly growing footprint in the U.S. While we're, of course, a Toronto headquartered bank, we're very New York centric. Sitting here on our trading floor, we have leaders across trading, structuring, and sales, global management teams that are sitting right here in New York, really leaning into what our franchise looks like specifically within the derivative space. RBC itself is growing massively. We have nearly 100,000 employees worldwide, 18 million clients that we serve, and our wealth management division is actually grown to now the 6th largest throughout the world and specifically within the U.S. RBC, one thing that we like to always focus on too is that we're the top credit in the industry. As you and I speak about structured products throughout this podcast, That's going to be something that's super topical and that we definitely would like to drive home. Obviously, as part of the structured product space, you're purchasing a bond and an options package. So to know that you're purchasing something with a top credit is extremely important. My role specifically has evolved since my time here in RBC. It was initially set to be purely within structured products, but as we're growing our derivatives franchise, my role has expanded too. So we're looking at more of a solutions-focused mandate that stretches not just across structured products, but insurance, ETFs, ETNs, and as you've seen and as we'll talk about, the growth of QIS is spreading not just within structured products, but across a lot of different wrappers.
Yeah, and what's interesting is just as the sophistication for the retail audience,
Absolutely.
Like those typical, those independent RAs, so far, it's just amazing what is available to folks nowadays. And frankly, your guys' pedigree and expertise has grown with that. So that's why we're thankful that you've been able to join us here today.
Yeah, I think that's super important too. What we've really noticed is that as looking at retail and specifically RIAs, it's not just the cookie cutter, equity bond sleeves that, these advisors used to place you in. There are so many different alternatives that you can focus on in this advisor. And at RBC, we really want to lead that effort to try to provide innovative solutions.
Yeah. Just as a quick side note. So when I get a call from a headhunter before I joined Halo, and I worked in institutional investment management with a strong background in structured products. And I get this call, hey, there's an exciting new platform. And, I think it's a good fit for you. And I'm thinking, oh, okay, cool. And it's like institutional type stuff. And I get over here and I'm like, wait a minute, they're doing this stuff for like the everyday investor now. And it's just amazing how far things have come. So let's dive in now. So, one thing that's really been interesting is a relatively new index that's the S&P 500 Market Agility Index, which is more formally called the S&P 500 Market Agility 10% TCA 0.5 Decrement Index, which in short we'll just call the S&P 500. Yeah. So it's a mouthful, and the podcast is only so long. So tell me a little bit more about the S&P 500 Market Agility Index and why you guys are excited about it.
Absolutely. So we went live with this index in February of 2024. One of the main areas that we like to focus on here is innovations and specifically listening to our audience, listening to what advisors are looking for, looking ahead at what we're visioning as topical and thematic, and blending those two needs together. With RBC, we have a fantastic structuring and solutions team and footprint. And then we also wanted to leverage S&P, who's best in class. They've obviously been around. They need no further introduction. Working with a brand like that allows us to bring in some of the ingenuity from RBC, marry that with some of the sponsorship and index creation capabilities that the S&P can provide, and really bring both of those together into what we're now delivering as this S&P Market Agility Index. When thinking about this whole space, and specifically for our index, it's important that we keep things rules-based. Everything is going to be 100% rules-based. There's no discretion from either the sponsor or the calc agent, and also extremely transparent. So this index was designed specifically to create a more tactical approach to your modern day 60/40, as we kind of alluded to in the beginning of this show. There's an evolution away from just traditional investing and sort of that set it and forget it type mentality. If you look at some of these different strategies that are coming out, we want to be a lot more tactical and a lot more dynamic. Call it, 2020 specifically, for a few years, all you saw across the headlines were the death of 60/40.
Sure.
COVID hits, right? The market goes crazy. The Fed comes in. They basically bring interest rates to zero. So if it wasn't dead yet, it was certainly dead post-COVID. And then come 2022, as we start to see the economy bounce back, we see the different change in the regime, and we start to see, a rebound in interest rates up into that 3 to 4%, now 4 and higher, that they're sort of oscillating around, and the emergence again of the 60/40 allocation.
Yep.
When we thought of S&P Market Agility, we said, how can we create a dynamic index that monetizes this view that isn't just long only and specifically catered to strictly 60/40, but rather more tactical in its approach?
Yep. What's really interesting about it, for those new to it, essentially the significance here is that the index, and like you said, rules-based, can essentially go long and short. And for those that are unfamiliar, that it is the S&P 500 plus U.S. Treasury, which are clearly bread and butter allocations, core things that, like most people are going to hold in their portfolio. And what's interesting about this is it's really hard to eke out, maybe, dare I say, alpha or something like that.
Yeah.
These core things. But what essentially you get that, to be clear, is with the indexes, because it can go long and short, it has the opportunity to deliver some alpha in more creative exposure. So as you guys are speaking to folks, what is the significance to say the ability of the index to go long and short?
1000%. That is one of the key dynamics. And before jumping into that, I should highlight this, and you brought it up. The two key constituents to this are S&P 500 and treasuries. Those are our two components, right? We're going to be allocated to both equities and bonds in the form of S&P and treasuries. Now, the index is designed to be predominantly long, right? We're not creating an index that's going out to effectively short the U.S. economy, but we do want it to be strategic. And there's certainly times, again, think COVID, think blips of 2022, when there was really nowhere to kind of hide, whether you were in equities and bonds. It can, to use your word, generate significant alpha by having this tactical ability to go short. So on the equity side, you are going to go short equities when 1 month price momentum has deteriorated and gone negative, and your 5-day realized volatility has spiked. That is going to trigger a short sign for the equity sleeve, and it rebalances daily, this index. So that short signal may change overnight, but the goal is typically, when you have those two, 1 month deteriorating price performance alongside increased volatility, usually you see that in sustained periods over, call it a couple weeks or months. During COVID, we were short for roughly 2 to 3 weeks during sort of that peak of it, which again generated some serious outperformance during that time. On the fixed income side, we're either long 10-year treasuries or we're short 2-year. And the way to think about this side is, as you start to see interest rates increase and you start to see the curve flatten, that will then trigger a sign for us to go short the 2-year. And the reason behind the 2-year is that it tends to react more quickly to any sort of change in regime. And in general, we don't necessarily want to be short sort of the safety haven asset of the U.S., which is the 10-year treasuries. So those two combined on the equity side and the fixed income side, again, it's 100% rules-based, will drive the signals to either be long or short. You're predominantly long, as I said, around 70 to 80% of the time, you're going to be long an S&P. But if you think back to COVID in 2022, like I mentioned, those are areas where you can see the short signal. And on the fixed income side, a perfect example is the post-COVID world in 2022.
Yep.
If you were just long 10-year treasuries, as we start to see an increase in rates, you're going to bleed on that mark to market. So the ability to go short treasuries in 2022 helped garner positive returns for this index at that time.
Yeah, it's interesting because essentially what you get here is the benefits of both long and active management. And I mean, it's something that is obviously when, if you're just buying indiscriminately as everything is going up, and obviously you mentioned it has a long bias, and I think most people, that's understandable, but this just it has the potential here to control volatility. I mean, it's got built in, you don't need to really think about it. So this is obviously a class of products now that are volatility controlled, managed. So when you're speaking with advisors about volatility management or control,
yeah,
how are folks thinking about this? As based on your conversations with clients, how are they tapping into volatility managed or controlled products?
This space holistically is growing, whether you're looking at insurance wrappers or structured products, and now we even, as I mentioned, ETFs and ETNs. The volatility component has really started to gain more attention as, one, we have more sophisticated abilities to hedge and manage that on our side, and two, we think more tactically and thematically. So with this specifically, one thing that we definitely want to focus on is the risk reward profile, or the Sharpe ratio. And looking at an index like this, by reducing the volatility and stabilizing that to the 10% target that we maintain,
okay,
one, it allows us to create a very consistent call option price, and two, it allows it to be cheaper. So if you look at something like the S&P, which as of recently over these past few weeks has realized lower volatility, but if you go back to December around the election, or around Trump coming into office, around tariffs talk, all these geopolitical risks, and you start to see some turmoil in the market, obviously that spikes. When you have something like a volatility controlled index, you have the ability to put out very consistent offerings. So what's really going to drive your optics or the terms of various notes is going to be more interest rate driven than anything else. So if rates are consistent, meaning your zero coupon bond is pricing around the same, your call option price is going to be consistent too, just because we have this 10% volatility component. So we're able to put out consistent terms month over month, and advisors have an understanding of what they can expect when they look at our offerings each month. When we look at the specific returns of this index, we annualize right around 10%. So we're looking at a Sharpe ratio of 1. And on something that does have a volatility target of 10%, that's pretty impactful, especially considering that we're looking at this in principal protected products or fairly safe investments, where you're now looking to achieve, premium to what the risk-free rate can offer.
Okay. So here's not to put you on the spot, this is zooming out from 10,000 feet, so very general here. In your conversations with clients, how are advisors thinking about this, the S&P 500 market agility index? How are they using it? Is said another way, do they view this as a replacement for something? And obviously, to be clear, everybody's objectives are going to be different, risk constraints and all of that. So obviously that takes into consideration. But is there a more general way to view this?
Yeah, we like to think of this as a replacement for some of your 60-40 allocation,
okay,
with an emphasis on equities. So historically speaking, you exhibit around 80% exposure to the S&P. If you think right now, year to date, we're up a little over 1%, while the S&P is right at around high 3s, low 4s.
Yep.
Right. So historically speaking, you generate around 80% exposure to the S&P. And again, if you look at 10-year annualized returns right around that 10% mark, the S&P is closer to, I think, 12, 13% over that same time frame.
Okay.
So you're getting a high exposure to the S&P while reducing your risk, just given that this has that 10% volatility target on it, and also now incorporating the bond sleeve. So the way to think about this is, as volatility is lower, you're going to have higher exposure to equities. As volatility increases, you're going to decrease that exposure to equities and lean more into the fixed income side of the puzzle. Now, the other advantage is what we just talked about, being the long and short component. If you're an advisor, it can be very burdensome to go in every single day and think about how you want to rejigger a portfolio, creating these long short positions, removing your exposure to bonds for a few months, and then going back in when you think that it's the right time. Having this rule-based strategy really tries to simplify that equation.
Yep.
And on top of all of this, the most common type of product that we see this is a principal protected note.
Yep.
In that 3 to 5 year space. So again, when you're looking at 10% annualized returns coupled with principal protection, if the index were to underperform, worst case scenario in 3 years, you're looking at receiving your principal back. So we really want to help advisors create a tactical solution that they can set and forget to some extent, right? Hold this to maturity and know that they're getting their fixed income and equity sleeve, again, with more of an emphasis or higher exposure, I should say, to that equity component.
Yep. So you mentioned principal protected note, and to be clear, we're talking structured note, which is obviously it's a terribly innovative index in and of itself. And again, this is S&P here. This isn't some obscure, a fly-by-night operation. These folks have been doing it for quite some time. What's really interesting, though, is RBC's innovation here in being able to bundle this with a structured product. So in your conversation with advisors, why the structured note? If somebody says, hey, okay, like I could tap into this some other way, why use a structured note to do it in the first place?
One, structured notes are looked at as an access product, right? Right now, we don't really have another way to invest in this index in pure retail format outside of a structured product.
Okay. And
you can think of this, outside of this particular index. I think it's important to think of structured products as an access vehicle as well. You can receive, or you can monetize various views on different indices, asset classes, alternatives within structured products. And I think that alone is why we've seen so much growth in the space, not to deviate so much from this index, but in the US, there was over $200 billion issued of structured products last year.
Yeah. That's
a massive increase. And the reason that we're seeing this is because they provide yield. If you look at them in income producing vehicles, they provide protection, and they provide innovation. And with this index, we're combining both protection and innovation into one offering. And I think when you also look from a principal protected side, that's also why you want to be taking into account credit. Again, RBC being at the top of the house here. And you want to take into account what you're linking to. If you look at principal protection, it's very hard to offer a principal protected note on a high volatile single stock because that call option is so expensive. So you're either going to have very low participation on the upside or a cap that you're thinking to yourself, we could blow through this cap in the matter of months, and then you're kind of just sitting on a note that you're waiting to mature. So providing access vehicles in the form of structured products to indices like these, if you are an advisor, it really allows you to differentiate your book and look significantly different than the guy who's down the street when a client walks in. This is a vehicle that can help create and help differentiate you and your business.
So last question for you. Mentioned differentiate your business. How, for viewers that are interested, how's an investor get in touch with you? What does the engagement look like? How can RBC help?
Yeah, absolutely. So we have an entire note team that's dedicated to all of the pricing, offering, marketing of the structured products. One of the best things that we like to do is partner with folks like yourselves over at Halo. We have a very deep, long-standing relationship. We rely on your team to really help facilitate a lot of those conversations with RIAs. They loop us in as they see fit to help explain the index or offerings that we have. On this particular product, we have out in the market right now a 5-year principal protected note. It is fully protected. Like I said, it has 2x leverage on the upside and it's uncapped. So when you're thinking about these 10% annualized returns, couple that with the leverage on the upside of 200%. Pending this index has performed like it has in the past, you have the opportunity to really outperform if you think of principal protected notes as sort of your replacement for a bond, right? That's going to generate some significant outperformance on the upside. So lean into your dialogue with Halo and your relationships over there. They will absolutely partner with us. We're always here to help with engagements like this. We travel, and we're certainly always willing to hop on a WebEx or a Zoom, whatever your forum may be, to help answer any questions on the index or how it works.
Yeah. What's impressive is you guys you're always willing to help, whether it's $1 million or $100 million client, you guys are there to help. So, and we highly appreciated your guys' partnership.
Likewise. And one thing I should add, between RBC and Halo providing the education, because we did partner with S&P, we absolutely tap into their marketing capabilities and what they're able to put out, from brochures to fact sheets. If you were to type in the ticker for this index, which is SPMKTD, right on your Google search, the first thing that's going to pop up is the homepage for the index. Within that homepage, you can see the index methodology. You can see the monthly fact sheet reports. You can see performance over the past week, month, day, year, whatever it may be. All of that is end client friendly. It's on the open forum. And you're able to see exactly how this works and dig as far into the weeds as you'd like. And that's extremely important from both the advisor and the client perspective, to know what they're buying and feel comfortable.
Yeah. The marketing collateral for this is impressive to be, so folks want to learn more. There's a ton of stuff out there. We're happy to put you in touch with it. Matt, as always, we're very grateful for your time. Thank you for joining the podcast. For viewers, hit that like and subscribe button. And Matt, we owe you a beer next time you get to Chicago.
I appreciate it. Maybe when it warms up in a couple months.
We'll it's freezing here, so let's make that in spring. So
I like it.
All right, thanks for joining.
Thanks so much, David. Appreciate it.